Welcome back to this episode number 72 of your Next Trade, called today Dovish Weakness. I hope you had a good summer. I was busy at the start of the month and over the last couple of weeks went more on holiday. So I went to France and I went to Greece / Crete. So a pretty good month of August. Clearly the market had a big move at the start of the month. I was lucky enough to be short the market, so I had roughly 50% net short exposure to the SPY and some put spreads. What I did is I bought back a day before the collapse on Monday. So when the VIX went into the 27-28%, I thought it was a good level. I should have wait a bit more, but overall, a month of August was pretty good to me. Then the next couple of weeks, I was more going into active trading, and the last couple of weeks I didn't do much. So hopefully for you, the month of August and this summer has been pretty good in terms of trading. I know that some trading educators will tell you that they made 30, 40, 50, 60%. We know those grifters. Unfortunately, I hope you're not going for those stories and you go for proper education. So let's start with what I saw. I'm going to be restarting trading over the next few days. The market is still very low in terms of volume, but what I find very interesting is in terms of stocks, we bounced back to the level that we had in July. So the S&P is at 5650 roughly for the S&P futures. But what is very interesting to me is in terms of asset classes, I'm looking at FX, and as you can see on that chart, I'm looking only at the euro dollar, but the dollar weakened by 4% over the month of August, and most of the asset classes will be at the same level that they were a month ago, but in the meantime, dollar weakened a lot. So as we're going to see today, the message from the market and from the FOMC, from the Fed, is much more dovishness coming and more cuts coming in 2024 and 2025. So that explains a bit, the weakening of the US dollar, but that's really something that we should be keeping an eye on. So what about the year-to-date asset performance? We are almost at 20% for both the S&P and the Nasdaq year-to-date, which are outperforming quite a big time the other indexes. We saw some big weakness at the start of this month, as I say, in August, end of July, mostly by the unwinding of the carry trade of the dollar yen. So it was not much about the end of the world coming in terms of the recession for the US, but mostly a carry trade, and there was a strong correlation between most asset classes and how the dollar yen was trading. So we went from 162 on the dollar yen to 144, 145, and we had, as I said, a strong correlation. The Nikkei, the Japanese index, went down similar 20% from the top, as it was mostly a carry trade that happened over the last 18 months. So year to date, we have this almost 20%, as I said, for the S&P, for the Nasdaq. Europe has been bouncing and is now almost double digits at 9%. Nikkei, 15%, but was up, 30% on the year. What is interesting is now WTI only 5% for the year, and gold has been making new highs. So gold at 2,500, there is still a chase for real assets, because if the FOMC, if the Fed is telling us that they are okay to run the inflation hotter than usual, that means the 2% target is probably now, at least for the next 18 months, a floor. That means, people are going for those real assets. And gold has been benefiting from it. If I look now at the week-to-date asset performance, it's almost like, it's a risk on that we had since the Monday lows that was at the start of the month of August. So we had the VIX spike, the volatility spike. A lot of products were short volatility. We had the carry trade unwind on the dollar yen. And since then, we had a smashing of the volatility, and every day we are going up and up and up and up. And that means S&P, Nasdaq 1.4%, the Russell outperforming. Why? Because when we are expecting the Fed to be more dovish, more accommodative, it favors small and mid caps in the US. But overall, as we've seen before into the previous slide, that the Russell has been underperforming the big caps. So for the week, this is the one that is interesting because again we see that the dollar has been weakening. We are talking 2% for the week. This is a big move in terms of probabilities, and again the dovishness of the Fed. Yes, that was not yesterday. That was a couple of days ago on Friday in Jackson Hole, where G. Powell said, we're going to be more accommodative and cuts are coming. And that means some dollar weakness as we see on that chart. So what about the year-to-date industry performance? The story is still the same. Semiconductors really outperforming 40%. We're going to have a big week for semiconductors because we got Nvidia earnings, and we're going to be looking at the implied move and the past move from the market. On the other end of the spectrum, solar, steel, transportation. But as we can see here, same story, the SPY is here. So that means very few sectors / industries are outperforming the market, whereas tons of industries are underperforming the overall market. That tells you that the market is very much driven by very few names. We have been talking about this over and over. We are not the only ones. It's pretty obvious. 25 to 40% of the indexes have been driving this move on the way up. What about the week-to-date industry performance? We got the home builders, big outperformer, 8%. And again, dollar yen, other end of the spectrum. This is not an industry, but this is an asset. And looking at those different timing, different time frames, week to date, year to date, since the bottom of the market. So I strongly advise you to look since how those different industries, sectors have been performing since the start of this month, which was the lows on at the start of August. And what you're going to see as well from this week, which is pretty interesting, the market was up 2%, but all the dodgy names, all the tech companies that are not making money, the most shorted stocks will be up 7 to 10%. So now we are going in the phase of the rally where you go for the shitty stocks, the shitty stories, and this is what has been driving mostly the market for this week. What about the sector performance? Everything is in green, at least for the year to date. The week to date, if we look at energy, we've seen and we will see later that CL1, meaning WTI, has been struggling a bit, but real estate, similar to home builders, everything that is rates related has been doing fine. Why? Because on the week to date, we are down 8 bips. So now we are trading at 3.8% on the 10 years. We are still inverted on the 10 versus the 2, but we are now far away from the 4.5% on the 10 years. We are at a level below the 4%. I don't do technical analysis on US 10 years, but you can argue that the 350 is an important level in terms of not technical again, but probably the target, first target that the Fed we will like to reach. What about the Fed fund rates? And this one is very important. So for the time being, the target rate are 5.5%. So what is the market expecting through the Fed fund futures? Let's look first at the September. So it's at 5.19. So that gives you 31 bips, minus 0.31%. So roughly we are expecting one cut plus, but interestingly we see that for December there is a 1% difference between 550 and 450. So before the end of the year, the market is now pricing a 1% cut. So that means, in other words, either you do 4 times 25 bips, but that's not possible. Why? Because the FOMC meeting, we're going to have 3 FOMC meetings before the end of the year. One in September on the 17th and 18th, one on November the 7th, and one on December the 18th. So if you want to bake 100, either you do minus 50 here, 0, minus 50, or you do whatever, but that is what we're going to have. So there are good chances now that looking at the NFP numbers that will be coming at the start of September, if the NFP numbers will be bad, there is a good chance that we're going to go to minus 50 bips. And looking at what Powell was saying, it to me, it feels very much like he would like to have a 50 bips, like making a big move first. So let's see, but again, 1% is expected cut before the end of the year. And if you go into next year, you can see that you are talking almost another 1%. So very aggressive Fed cut expected. June is at 3.47, so that gives you 2%. So 1% before the end of the year, another 1% in the first half of 2025. So market is pricing that very aggressive cut going forward. What about the VIX? Now we are at roughly 16%, so 15.86%. If you don't know the rule of the 16% on the VIX, that tells you, and I've done a video in the past on YouTube, so you will find it, which is more or less the market is pricing on any single day a plus to minus 1%. That is, versus history, VIX is at 19% something. We went recently into the 12 to 13%. So two ways to look at it. When you smash too much volatility, you get the risk of the volatility spiking, as we saw at the start of the month. And as well, when volatility is in between and there is less uncertainty, there's a good chance that products will be selling volatility. So I would like quickly to jump into technical analysis, starting as always with the S&P future. So the trend is still your friend. We have not been making new highs yet. We are roughly 70 points from the S&P highs. The charts are always been looking at the same, so we go up and we test those ones. So for the time being, I've not been putting any new shorts. I've been lucky, as I said, to bought back a bit early, but it was a good month for me. For the Nasdaq, it's not as good as the S&P. Russell, bouncing as well. So picture is more or less the same. We have been bouncing. We are very close to the all-time high. If you look at the meta of the fabulous 7 of this world, we have been trading sideways versus the overall market. That one is interesting is oil, because we went and tested the 72 levels, and despite all the noise that we have in the Middle East, CL1 WTI is still struggling. So I've seen a lot of people on Twitter saying, it's too cheap, it's too cheap. The reason is pretty obvious. There's tons of supply coming into the market, and as long as this supply is coming into the market, it's hard for CL1 to bounce. Copper, we have been bouncing back onto that level. Now we are trying to find the new direction. Gold making new highs, 2,500. The trend is your friend. I'm interested in the euro dollar, because we have seen a lot of euro bears and dollar bulls over the last few months, especially after the French election that we had in June, and that makes always smile, because people will come to me and say, "Look, Greg, as a French, you should know, France is a piece of shite, blah blah blah," and then they go short the euro, and then they get murdered by 3 to 4%. So always be careful on the noise on Twitter, but it's interesting to see that the weakening of the US dollar, we are talking 4% over a month. This is really a big move. And that is explained partly by the dovishness of the Fed, and I'm interested going forward. What are the implications? Obviously, this is not great for the exporters in Europe. We want to see how those moves in the dollar yen as well will be unwinding. Now we are into interesting level. The 145, 144 was an important level, so we are roughly into that level. We quickly moved from 161 to 144. I was short as well around, I was lucky, 160, 175, but I bought back way too early at 153, 154. And you look at this trade and say, okay, I could have been making much more money. What about the Europe with the stock 600? The chart doesn't look that bad. We are close to the all-time high again. It's 1%, 1.5% from the all-time high, similar to the S&P. So what I'm looking at now, because I'm back to trading slowly, is probably don't fight the trend so far. I want to believe that we get the big expiry in September and we get the elections coming. So we got these big drivers, which are the election. If you look at the past move, most of the time September is a bad month for stocks, but it's bad month after the expiry, and September, October is a bit wobbly. So in terms of technical analysis that we just look at now, I just want to describe what I saw from this week in a very quick way. So risk on, this is for the S&P. We go the same, we go up, we squeeze, we go flat, and we squeeze. So it's a very similar market that we had 3 months ago. You go up 50 points, you go down by 10, 20 points, then you go up another 50 points, and you rinse and repeat. You get the weakening of the dollar, so that's for your DXY, dollar really weakening, and as well you get the summer volume. So here I'm looking at the ES, meaning the S&P futures, and as you can see, we had the big spike in terms of volume at the start of the month, but overall we had very low volume, on the SPY, which is the ETF for the S&P. We were trading for many days below 40 million. So Powell dovish, dollar weakness, risk on, so far that has been the trend. What about the catalyst going forward? As always, we do 3 things. We look at the macro, we look at the earnings, and we look at what could happen, what are the other drivers. So in terms of macro, we get the PCE. If, inflation still matters, that's going to be one of the macro data for the week, PCE on Friday. Other than that, we're going to have some housing number and some leading indicator to the Richmond Fed and some others. Secondly, this is the big one. This is for the earnings, and this is about Nvidia, but you get as well some other names. You got CRM, you got Lululemon, you got Dell, you got Marvel. So for the artificial intelligence / semiconductors, you got some good names. And I'm interested for you to understand, how options have been priced. So very often people come to me and say, oh, implied volatility is coming, how the market makers are pricing implied volatility. That is absolutely nonsense. It is pure common sense. So one way to look at it is you look at by how much an asset, and here in that case, this is Nvidia, has been moving in the past. So on the last 9 occurrences for Nvidia, the stock has been moving by 8.6% on the day. And so this is what we call your realized volatility, your historical volatility. And we should be comparing this realized volatility to what is the market for the expected move on that, and that will be for the Thursday, because Wednesday Nvidia is coming after the close. So on Thursday, the market is expecting a 9.3% implied move. So that is not very different from your historical move. And what you're going to see is most of the time, as an insurance, you're going to be paying a bit more than what has been happening. So instead of having 8.6%, you get 9.3%. So this is the expected move. What about the expected move for the S&P for the week? Similar, you can do the same. You can do an at-the-money straddle on the S&P expiring next Friday, and you will find it's plus minus 1.4%. So we went to more than 2%. We went below 1% recently. So that gives you the move. And we know as well that the VIX these days is pricing roughly a 1 plus or 1 minus 1% move. What about the seasonality? Even if we're going to have another week, this is the end of the month on Friday, and we should expect a bit of funny moves going into Friday and on Friday in the last hour of trading. But very often what we have is the months of August and September are not great for stocks, especially September. So seasonality is not great. So if you look at the last 29 years, S&P has been done minus by 70 bips roughly. And what is interesting is this is something that I discussed 4 years ago when I did a webinar on how to make money trading US election. I should probably do the same again. As you will see, most of the time the first 3 weeks of September or before the expiry are fine, and that's after the expiry that we start to weaken a bit. So seasonality always important. And finally, in terms of supply, bond supply, we got 70 billion of 5 years and 44 billion on Thursday of 7 years. So always at the end of the month, a lot of bond supply, which very often keep the yields on the different maturities of bonds pretty big. So we should see bonds staying probably at the same level. So this is it for me for the week. Just to tell you again, because I had many questions, so people have been asking me, Greg, are you still doing mentoring? I'm still doing mentoring. So if you have interest of learning how to trade with your money during 12 sessions over 3 to 6 months, you can send me an email. I'm still doing the same. There's still the 4x4 video series if you want to learn the full process. We have the trading community on Discord. There are some free channels. I'm thinking about moving this trading community into a paid paywall. That is something that I'm maybe considering. So finally, any questions, you can reach me, send me an email. So again, this is it. Slow market in terms of volume, but market participants will come back to their desks. So we should expect a pickup in volume and some activity, and more importantly, we got Nvidia around on Wednesday, so that will give us some color and on the semiconductors and some other names. So this is it for me for the week. Have a good trading week, and I'll see you next week. Bye bye.